All right. Today is Sunday, the 22nd of October. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. I hope everybody had a great weekend. For me, I don't know, I just got stoned, sat on the couch, watching TV, and then comes up this possibly the dumbest movie I've ever seen in my life. It's called The House of Gucci. It's about the Gucci family in Italy. And of course, it's a typical romance Italian drama. Somebody gets whacked at the end. But I'm watching this movie and I'm like, okay, everybody's Italian in the movie. So you'd think the movie would be in Italian and then we have some English subtitles, or maybe in just regular English, but they're doing this weird English with an Italian accent, and it's really comical Italian accent, which is really bizarre to watch. Why are they talking to each other? Like, hey, Paolo, what you doing to me?
Our name, sweetie.
It looks like he's given up.
Goodbye 1930s. Hello 80s.
No, it's me, Paolo.
I'm telling you, this movie is one of the dumbest things I've ever seen, but it could be fun if you're stoned. But you know what's not fun when you're stoned? It's the news. Nothing good is coming out of the news these days. I mean, just look at Sarah Silverman. She got stoned, she watched the news, and then she tweeted this. Of course, later on she apologized and blamed it all on the reefer. So stop watching the news, kids, because I'll do that for you. I'll suffer the agony of watching all of the news and the fake business news that we have in this country here. And I'll summarize everything for you. And in a nutshell, we're heading into a real massive shithole, the likes that we've never seen before. Why do I say that? Because we have this insane fiscal policy and racking up a lot of debt, trillions of dollars, while interest rates are going higher. And on top of that, we want to fund more and more and more wars. And now for the first time, we see the consequences. Before, you can print all kind of money and fund all kind of wars without any consequences. We can do this forever. Well, you thought wrong. Because now we have a consequence, and this consequence is nobody wants to buy our junk debt or trash dollar. Nobody wants to buy the debt of the big bully without being compensated with astronomically higher interest rates. And we see bond yields surging higher, which will create havoc in financial markets, get us into a credit event, and bankrupt this country. Let's back up here for a minute, because this week, the President of the United States, Joe Biden, came out with an important speech about the need to fund more wars, more foreign wars, and how good that's going to be for the economy and for the country. You wait and watch. It's all worth it. It's an investment in war. It's an investment. It's going to work out. Just be patient here. It's all going to play out, just like the Inflation Reduction Act. Whoops. But it felt sort of listening to a tyrant when I was hearing the speech. And now I know who I'm going to be this Halloween. I'm going to dress as Joey B, go to the nightclub and sniff a bunch of ladies, and end up spending the night in jail. But anyways, let's hear what the tyrant said in his speech.
Saddam Hussein has placed Iraqi troops and equipment in civilian areas, attempting to use innocent men, women, and children as shields for his own military. A final atrocity against his people. I want Americans and all the world to know that coalition forces will make every effort to spare innocent civilians from harm.
Oh, producer, come on, not the dumb tyrant. Give us the senile tyrant, please.
I know these conflicts can seem far away, and it's natural to ask, why does this matter to America? So let me share with you why making sure Israel and Ukraine succeed is vital for America's national security. You know, history has taught us that when terrorists don't pay a price for their terror, when dictators don't pay a price for their aggression, they cause more chaos and death and more destruction.
And why is this a problem? The president says, oh, we have to invest in these wars, otherwise we're all going to die. Democracy will collapse. So we have to engage in all of these wars. Well, the question now becomes, do we have the money to fund these wars? And if you said, no, we don't have the money. You got it right, baby. You got it right. Because we're running budget deficits. So there is no revenue to pay for all of these wars. So how are we going to pay for all of this? Number one, we can raise taxes, make you pay 70-80% in taxes, to sustain the empire. Or we can just issue more bonds, right? Issue more bonds, print more money, and keep it going. The problem is we have inflation now, which inhibits the Fed's ability to print money freely, number one. Number two, nobody wants to buy our debt anymore. We have concerns about the fiscal policy. Folks need higher rates to buy your junk bond, your trash debt that you keep issuing more and more of. if your financial house is in shambles, if you keep running budget deficit after budget deficit after budget deficit, at some point the buyer of this debt will say, okay, I need higher rates. This is too risky now. Number two, a lot of countries say, you know what? Why fund the big bully that wants to intimidate and create wars all over the place? Why? How about we just diversify away from the dollar and buy real assets, gold, silver, create new alliances between countries rich in commodities, and trade based upon a common currency that is besides the US dollar? We'll expand on that a little more, but the point being here is, what is the end result of the dynamics that we see in the bond market and the debt market these days? Higher rates. The buyer of your debt demands higher rates. They're going to get higher rates. And the problem with this is, the more debt we issue, the higher rates go, the higher we pay in interest payments. Not just you and me, the consumers, when we pay credit cards or mortgages, but also the federal government. And now the interest payment alone is about to exceed the entire budget of the Defense Department, which is what, $700 billion plus per year? We're going to pay more than that in interest payments alone. And all of this new debt issuance will go to replenish the stockpile of the United States military, because we've been sending our weapons to Ukraine for over a year now, billions of dollars, and now we're pouring billions of dollars of weapons from our stockpiles to Israel. So now comes the blackmail. Well, our military now needs replenishment. It's a dangerous world out there. And if somebody attacks us, God forbid, we're shit out of luck. We're out of weapons. So what are you, anti-American? You don't want to pass the $100 billion that Joe B is asking for? Who cares? Interest rates go higher for a little while. We'll suffer for a little bit, but we'll manage. Well, here's the problem. The $105 billion, because you got to add the 10% for the big guy. But anyways, $61 billion to Ukraine. $14 billion to Israel, $6.4 billion for the borders of this country. Some say dead on arrival, some say that no, it's going to pass, because now it becomes a blackmail operation. If you're a politician and you turn down this request by the White House, you'll be labeled as, what are you, anti-Israel? You don't want to send the $60 billion to Ukraine? What are you, against America? You don't want to protect the borders by sending $80 billion to foreign countries? What's wrong with you? So if I had to bet, folks, I would say it's going to pass. But who knows? We don't even have a Speaker of the House right now. But folks, we've been watching the stock market, and now we see that the geopolitical situation is impacting financial markets across the globe. So now all of a sudden the market becomes geopolitical. And we see that the act of brushing it off, or nothing matters anymore, well, all of a sudden it matters. We see de-risking all over the place. De-risking in buying puts on equities, so we see the VIX moving higher, de-risking in gold going higher, silver going higher, oil going higher, defense contractor stocks going higher, but then the rest of the market is going down. And have you noticed that absent from the de-risking and the rush to safety is buying U.S. bonds? For the first time in history, U.S. bonds are no longer looked at as safety. So we see the value of bonds going down, yields going higher, regardless of the geopolitical situation. So what does that say? The debt of the U.S. is no longer safe. We need to put higher and higher rates to make it worth it for somebody to buy this trash. But now, since we are in a geopolitical market, what are the risks here? If we game some outlooks, for example, we know right now that the invasion of the Gaza Strip, the grand operation, that's in the bag now. That's going to happen. All what the diplomatic efforts did is delay it for a little bit, allow for some relief to come in, but that's about it. Now it's going to happen. Okay, now let's begin with the easy one. What will be the response? The pictures coming out will be really, really ugly. We know that in the Arab side, the oil and gas producing nations, they're not really happy with what's going on here. From the UAE, you start to hear some more and more criticism, even directly naming the US as a part of the problem now. In Saudi, calling what's going on in Gaza as heinous. So there's a lot of domestic pressure here going on in these nations. And they're going to have to respond at some point if things get really ugly. Now, these nations happen to be allied with the United States, so we know that the military option or engaging in war is not really on the table. So what's on the table? It's an economic course of action. If you look at Saudi, for example, what is the incentive here to cater to the U.S. when China does triple the trade that the U.S. does with your country? It's not even in the top 3, not even the top 5. Well, the only course of action is somehow restricting the supply of oil and gas, whether by an official embargo or an implied one, and this will push oil prices significantly higher. Some would talk about $100 a barrel. North of that, I would say 150 and above will be plausible. Even $200 a barrel will be in the cards. Now, the other player is Turkey. What are they going to do here if the pictures become really, really ugly as we see the ground invasion of Gaza? We know that Erdogan is talking tough, and he has a lot of pressure from the domestic population, so at some point he has to respond. Turkey happens to be a U.S. ally, a NATO member, so are we talking about a military response here? I don't know. I doubt it, but something will happen here. They're going to respond somehow. They're going to have to respond as the pressure keeps building on. And folks, that's the easy part of gaming how this is going to play out. Now we have to talk about the expansion of the conflict in a military stance, not an economic one. Sure, maybe the oil-producing countries will somehow begin an embargo, or maybe Turkey will restrict some economic support or economic trade with the European Union, maybe to add some pressure, who knows. But for now, the assumption with these two that the response will be economic. What about the other players, though? Because we know that the invasion will happen in a massive piece of the strip that you see here, and a lot of people still live there. We know if Israel takes down Hamas, it means that it can replicate that kind of success and take down Hezbollah in Lebanon. So we know that in the bag, along with the ground invasion, is a response by Hezbollah. And they say that they're already in the war. We don't even have to wait for that. They're already in the war. But for now, so long as the conflict is limited to some skirmishes along the border, the United States is just watching for now. Question now becomes, what if Hezbollah, for example, expand their attacks? Rockets, maybe invasion, who knows? Then at that point, the United States will have to respond by using the aircraft carriers to conduct airstrikes in southern Lebanon. Okay, so now we have a proxy war between the U.S. and Iran happening in southern Lebanon. And we also have Israel-Gaza going on. Well, at that point, we know that Iran will still be careful not to engage the U.S. one-to-one. So they're going to retaliate via proxies. And we have a lot of troops all over the Middle East. And this is a little outdated, but the point being here, we have thousands of soldiers in Kuwait, in Iraq, in Syria, in Jordan, in Bahrain, in Qatar, UAE, all over the place. Well, Iran is going to target some of those. What if they inflict huge casualties in one of those attacks? Then will the U.S. up the ante and bomb Iran at that point? You see how crazy this can go? Way out of hand rapidly. And now the market begins to realize that look, the worst is not behind here. And we can go into the weekend and something big takes place. And this is why we went from crush the VIX Fridays to buy the VIX Fridays, dump the stock market Fridays, because we have no idea what's going to happen in the course of the weekend. And now there is talk that maybe China is getting involved with 6 warships in the Middle East already. So can we see the involvement of China? And by the way, we didn't even talk about Syria and Russia being there. This is insane. And now we got China all of a sudden. And by the way, they talk about, Joe Biden talks about, deterrence. We have to move all of these aircraft carriers and all of these thousands and thousands of troops to the Middle East as a deterrence for China. Well, I say with all of these assets in the Middle East and in Asia right now, in Europe, we're wide open here. The borders are open. There are no significant military assets guarding us right now. You look at the Eisenhower, that's going to move closer to the Middle East now. So I say if China wants to take over the U.S., this is the time. All of our focus is overseas. We're depleted. We have an insane problem with debt. What do you think is going to happen if China invades the U.S. right now? It's an absurd scenario to think about, of course. But understand at some point we're going to get into conflict with China. I mean, these are not my words. Joe Biden, the president, says that if Taiwan is attacked, and we know that China is going to take over Taiwan, that's inevitable. But he says that if they do that, we're going to be in. We'll fight China one-to-one on behalf of Taiwan. Do you really think that we can fight China at this point? Depleted, full of debt, and by the way, who's going to fight? We're going to need a draft here. The recruitment in the military is absolute disaster, regardless of the bonuses, the relaxed policies, the hip and woke military that we got these days. Nobody's signing in. Not to mention, of course, that the military that we have right now requires Ozempic. You really think we're going to sustain and fight China at this point? Or is this just a cover-up, a facade, projecting all of this power with U.S. aircraft carriers and nuclear weapons, which, by the way, we've done a nuclear test here in the state of Nevada this week. Isn't all of this just to cover up the fact that in a real war, we're not going to last? And we can't really afford to be in war to begin with. But again, this reckless hegemony, what is the result now? There is no deterrence. The Russians are now going to say, okay, this is a green light for us to test nuclear weapons too, just like you guys did in Nevada. The Chinese are now building massive arsenal of nuclear weapons, 1,000 warheads by 2030. Nobody's deterred here. Everybody sees a wounded animal, be it Russia or China or anybody else. They say, okay, how are they going to pay for any war, a real war? How are they going to afford fighting this war? The country is already drowned in debt. We're now exceeding $33 trillion in public outstanding debt. Debt as a percentage of the GDP has now exceeded 100%. We haven't seen that since the Great War. So now we have debt exceeding GDP, even though we're not a real war yet. You see how insane this is? We keep running budget deficit after budget deficit after budget deficit. The balance remains negative for the federal government. And the choice either to tax to death 70%, 80%, 90% to fund all of these wars, or keep issuing bonds. But who's going to buy them? In the past, the Fed bought all of these bonds and funded the wars. Now the Fed is doing quantitative easing, dumping bonds, reducing assets because of inflation. And as rates go higher, the Federal Reserve of this country is now in the hole, losing $110 billion on their balance sheet. The Federal Reserve now has to inject $700 million per day to keep this zombie economy going. And we think that we can afford spending on steroids and issuing all of these bonds and funding all of these wars? We have lost our minds here, folks. And the biggest buyer of this debt, China, say, you know what? All of this deterrence act, we see a wounded animal, a collapsing empire. We're smelling blood now. And you know what? To fund your wars, we have to lend you money. Now, why would we do that? We're not going to do that anymore. And here's the headline. China sells the most U.S. assets in 4 years, dumping $21 billion of U.S. stock and treasury bonds. China is already saying that, look, we are in an economic war. You ban our products, you ban us from importing your advanced chip products. Okay, we're going to start a war now. In the past, we talked about restrictions by China of exporting rare earth metals to the United States. Now China is curbing graphite exports. In other words, they want to handicap the electrification of vehicles because graphite is a really important element for batteries and also chips. And when the world sees a wounded animal, a big bully, they don't want to do business with that anymore. We see BRICS expanding, now including commodities, rich producers, China, India, Russia, Indonesia, Brazil, and now we see Saudi joining, Egypt, Iran. The world is now saying goodbye. The way of the past of the dominance by the United States, that's over now. And it's all by your own doing, by repeating the same mistakes over and over and over again. Endless wars, endless borrowing, a Ponzi scheme stock market, pumping everything with fake money and debt, and running budget deficits year after year after year. Well, all of this is now catching up with us, and the world sees us. So in the speech of the president this week, there's a projection of strength and unity, and oh, we're still the best here. The world looks up to us. But in reality, the opposite is happening. We're in a decline, folks. And the moment you understand that, the moment you understand that the course of action has to happen now, otherwise we're doomed. And of course, the Fed, that's another freak show. Jerome Powell, with all of this chaos that's going on in the bond market right now, he says, oh, we're just going to let bond volatility play out. We have the value of U.S. bonds crashing in a collapse, and we see interest rates moving higher as a result. And the Fed says, yeah, we don't know why this is happening, but we're just going to let it play out here. We'll watch, we'll react after the fact. Folks, when we talk about the insanity going on in the bond market right now, of course the supply issue comes to mind. Of course the debt comes to mind. Of course the endless wars come to mind. But the primary reason why we've seen bond yields going higher is the insufficient, cowardly Fed that de-anchored the bond market from expectations. And now the expectations can run wild. If you say 5% of the 10-year, sure. I say 5.5%. The other guy says 6, 7, 8, 10, 13%. Who's to say that's not going to be the ceiling? Because there is no policy action by the Fed to guide. They're a follower, not a leader. They're not in charge, inflation is. That's what allowed this chaos to begin with. Had they approached this with a Volcker-like approach of letting action speak louder than words and guide markets, that your policy and your guidance is simply, I'm not going to let inflation win. I will do whatever it takes to take inflation down to the Fed's target. And if that means a recession, so be it. If that means the stock market will go down and the Wall Streeters and the donor class will be upset, so be it. But I'm defeating inflation. And that's how he managed to defeat inflation. But spineless Powell, he doesn't have all of that. He keeps saying data dependent, data dependent, data dependent. And that is an absolute disaster to the point where now U.S. debt is acting as junk bonds. I'll let Mohamed Al-Arian explain. Take a listen.
We know supply is going to go up, and supply is going to go up in a serious manner because of what's happening to the government deficit. We don't know where the buyers are going to be and at what level. So we will probably overshoot like you say, in order to find the buyers. The trouble with overshooting is that it causes distressed sales. And that's why the more we move violently like this, the more you risk an even larger overshoot. Now, that's a dynamic, a technical dynamic that we typically see in emerging markets in a high yield. We are seeing it, Mike, in the most important segment of the financial markets, which is U.S. Treasuries. They are benchmarks for so many other things.
And of course, in the interview comes the propagandists in CNBC and say, but Mohammed, come on, what do you expect the Fed to guide things? You just have to follow the data because they're all afraid that the Fed is going to raise rates a little too high and they're going to lose the value of their investments in real estate and stocks. That's what it boils down to. Why don't we let the Fed just do the job? And they can't do the job by being a follower. They have to be a leader. They have to guide. And Ilarion makes that point clear. Unfortunately, even Mohammed is now losing his mind. Watch what he says at the end. Take a look.
Mohammed, I got to pin you down on that, though. I'm sorry to cut you off, but to pivot away from data dependence is to provide guidance. So if he pivots from the data dependence, what's the guidance he pivots to?
So, Steve, you know how absurd it is to have this excessive data dependence? You are dealing with an institution whose tools operate with lags. So the notion that you are targeting a forward-looking economy in either 6 to 18 months using data that's backward-looking, that's inherently inconsistent. And yet the Fed has ended up in that trap. That's why.
Well, what else would you look at if you're not looking at data?
They have to pivot to a strategic vision. And for me, we are seeing major inflection points technically and economically. And the message to give right now is the Fed is done. We're done. That's what the message should be.
So all I got to say is a massive facepalm. He got it all right. That the Fed failed. They should have got it. They should have led the bond market, not let inflation in the driver's seat and be a follower. But he says they should have done that by saying that they're done and they're not going to raise rates anymore. Mohammed, they're already done that. They paused interest rates. They sent their zombies all over the place saying that we're done raising rates. It's not stopping the bond market. The only way to stop the bond market from collapsing and for yields to surge higher, believe it or not, is for the Fed to hike rates significantly higher, to issue a signal to the bond market that, you know what, we're not playing games anymore. We're taking this inflation down. CPI, PPI, all pointing out for a rebound in inflation. You know what? Enough. We're going to raise rates 50 basis points in the next meeting. If we have to do another 50 in the next meeting, we'll do it. We'll do whatever it takes to take this inflation down, regardless of a recession or a crash in the stock market. Then you'll see bond yields stabilizing and the value of bonds recovering, because now we have faith that the Fed is in charge, not the other way around. But of course, you're not going to hear this opinion at all in the mainstream media. Never. You're never going to hear this kind of talk. When are they going to talk like this? After the disaster happens, after the crash, after the recession is already in. And lucky for them, this could happen really soon. As bond yields continue to go higher, the equity risk premium is now the worst since 2004, and it continues to go down. It will be the worst risk premium this century so far. It is not worth it to buy or own stocks anymore, with bond yields paying you 5.5%. And even cash is now paying you more than equities. For the first time this century, all of a sudden we have alternatives. The equities market is not worth it anymore. Why would I take the risk? And the warning signs are all over the place. This is not a bull market. This is a raging bear market. Just look at what's going on in the leading indicators such as Dow Transportation Index, the Dow Theory. That index is crashing right now. When it comes to corporate earnings, we're seeing declines. We're seeing downgrades taking over upgrades. Is this really a bull market or is it a bullshit market? And by the way, if you meet your top line and bottom line in this earnings season, you're still going to go down. If you miss, oh boy, a lot of pain is coming your way. Look at what happened to Tesla this week. You miss? No mercy at all. It's going to be a really interesting earnings season here, folks. What's holding this fugazi stock market right now? The so-called Magnificent Seven. And just like in the movie, a lot of them are going to get whacked. A lot of them are showing a lot of signs of weakness right now as we speak. We all saw the headlines this week about Apple, that Apple lost its #1 position in China. It has been dethroned when it comes to sales to Huawei. Now, the perma clowns, the perma pumpers will come out on TV and say that, China doesn't really matter that much to Apple anymore. Oh, really? Because the revenue growth from China is what kept this company from declining revenues and declining growth in the last few years. Now as China slows down, we see that Apple revenue is also going down. growing negatively year on year. And of course, Apple is an apologist to China. They got rid of Jon Stewart to appease China. And let's see how that's going to work out for them, because it doesn't seem that the Chinese like them anymore. It seems that they're lagging behind in terms of innovation. Their products are being beaten right now. So now we have the most important stock in the market, the most important member of the Magnificent Seven, so-called Magnificent Seven, wounded right now. But of course, the poster boy of the mania is none other than NVIDIA. And this week they got hit too, with the US export bans of AI chips to China being expanded now, including all of the loopholes that allowed NVIDIA to hoard an insane number of revenue because of Chinese double ordering and back ordering, which is not going to happen anymore. So all of a sudden, the AI narrative that inflated this bubble in this stock is collapsing. And if you look at the SMH, the chips index weekly chart, look at what's going on here. This is the first time this year when we see the weekly chart breaking below the 20 weekly moving average, retesting it, and fail to reclaim it. In other words, we have a confirmation that now, in all likelihood, we will see chips entering a correction, and the correction could morph into a crash. So we have a lot of members of the Magnificent Seven being wounded. And as we expand this earnings season, we might see more and more signs of trouble in these names. The question becomes, if these names go down, will the equities market hold? If transportation is crashing, if utilities are crashing, if consumer defensives are crashing, if metals are crashing, if industrials are crashing, if real estate is crashing, if banks are crashing, if cyclicals are crashing, what is left here in holding the stock market? Energy? That's inflationary. The Ozempic mania? What else? It's really the AI mania, the big cap technology stocks, and they're gonna crash. There's a point of pain here where folks say, okay, this is not really a bull market. This was a massive historic trap here. And we all have to rush to the exit door at the same time now. And I think that point is, if you look at the monthly chart for the XLK, the technology ETF, right now, if you've been holding this year, if you bought, let's say in May or in June, July, the chart is holding pretty good. But as we go down to the top of the bear market rally from last year, because once we passed that, a lot of folks said, okay, maybe I was doubtful because of the collapse of SVB, but now that the chart is trading above the top of the bear market rally since last year, maybe indeed that we have something new here. And I have FOMO, I'm going to buy now. I'm going to buy Microsoft, Apple, NVIDIA, you know the deal. But if we go down there, we take that level down, we break that support, then that entire narrative collapses all of a sudden. And the rats will run to jump ship all at the same time. And that's what create those kind of flush down and crash like scenarios. And I think we're going to see one of those, perhaps the most epic one we've seen at least this century so far, or at least since the dot-com bubble. We're going to see it, and maybe earnings season will be the leading catalyst to that happening. And where will the money rotate to? How about real assets, tangible assets that are really cheap right now? Commodities, gold, silver, copper, grains, food, meats, softs, lumber, land. That's where the money's going to rotate to. This is why the billionaires, they come on TV and say everything's fine, the stock market is fine, just put your blindfolds on, and it's all going to end up being happily ever after. But at the same time, they keep buying land, they keep buying farms, they keep buying gold, they keep buying real assets. Why? They know the inevitable. They know that this charade is going down. And maybe the nail in the coffin is the obsession with these foreign wars and racking up insane amount of debt. And we're now, for the first time, at least this century, we're paying for that. We're seeing the consequences now, and that's the message of the day. But folks, let's expand the conversation here a little more and cover the market for you. And we begin with the closing of the indices last Friday, and here we go. The diamonds closing in the red, down by 286.89 points, or a decline of 0.86%. The Nasdaq in the red, leading the pack to the downside by 202.37 points, or a decline of 1.53%. S&P 500 deep in the red, down by 53.84 points, or a decline of 1.26%. Sectors on Friday, all negative, led by technology, the risk on. Cyclicals also risk on. Energy. Why was energy down even though crude was pretty much flattish? My hunch is we have some profit taken here. So we have a rush to cash all of a sudden, taking some profits from the hedges from last week. Gold, silver, energy, defense contractors. Now what happens to that cash will dictate what happens for the remainder of the month. When we contrast this with the weekly picture, what do we see here? Rates going higher. What happens? Real estate at the bottom. Cyclicals, high in debt, began to suffer. Any expansion theme, industrials, technology, risk on, financials, with the exodus of deposits, all losing for the week. The winners, not by a lot though, defensives, maybe got oversold now. Maybe we see value in some of these names. Matter of fact, defensives, the consumer staples are really, really cheap because a lot of yield-based investors, as we saw bond yields, the risk-free rate going higher, they dumped these consumer staples, be it Coca-Cola, McDonald's, Mondelez, General Mills, Procter & Gamble. But now maybe some of these names become really, really cheap. We see the entrance of value investors. And we no longer look at these names as, oh, they're only good for dividend. Maybe they're now good for value. Of course, we can't say that with a lot of utilities and real estate. Those are still exposed to a lot of risk when it comes to the economy. But the consumer staples, we know that they do pretty good under a recession environment. Now, energy was slightly positive for the week because of the hedges due to the war. A lot of that cash was taken out on Friday. When we look at the breadth here, it has been awful throughout the week. Friday was no exception here. NYSE 21% advancing versus 77% declining. The NASDAQ 28% advancing versus 69% declining. So we know we're getting closer and closer to a point of an oversold rebound. The question now becomes, do you buy the rebounds? Or are we still in a catching a falling knife type of situation? I think we are still catching a falling knife. For now, we haven't seen the classic signs for a bottom yet. When we look at commodities, we know that the dollar was pretty much muted on Friday, but we see energy pretty much flattish for the day. Some profit taking from crude oil, from diesel, but we see natural gas continues to be the loser of the week due to number one, weather forecast, number two, the end of the strike in LNG facilities in Australia. When it comes to metals, we see that the precious metals are still holding. Gold and silver. Silver was up over 2% on Friday. But then we see drops in the cyclical side of metals, copper, palladium, all down on Friday's session. When it comes to softs, cocoa continues to go higher along with OJ and coffee. When we look at the week all in all, we see that soybean meal futures came on top here, gaining about 9% for the week. Coffee at number 2 with about 7%. And then cocoa at number 3 with about 6% or so. Natural gas is the loser for the week, down about almost 10%. But again, that comes on the heels of massive gains in the last few weeks. So we're looking for a rebound here in natural gas. When it comes to coffee, though, we said on Monday that I do like coffee at this point. I think it bottomed. I think we should be buying some coffee contracts. This was the trade of the week, and it paid off. Now what? What we see is that we have a series of lower lows, but now we also have a higher high. Maybe a little too exhausted here. So we're looking for a formation of a higher low. And if it holds and the chart begins to appear to make higher highs, then we add to coffee at this point. But for now, we have reached the profit target at around 164.5. So now we're waiting for a pullback, rebound, and then hop again. Moving on to the big casino, the options market, what do we see here? Apex Friday, of course, the volume will be higher, but we saw more buying of puts this time around, anticipating more drops to come. Almost 50% of the volume in Tesla was puts, almost 50% of the volume in Nvidia, and in Apple was also puts. BofA, look at this, almost 70% of the volume was puts, not calls. Something bad is happening in this company, so watch out for BofA. When we look at the 5 days average put-to-call ratio, what do we see here? I told you we're going to drop again, creating a fake rebound. A lot of folks get sucked into calls, and then we drop again in the market and we see more buying of puts. And the trend is still intact for now. Higher lows, higher highs. So the question now becomes, and I believe that this will be the case, for us to have a legitimate bottom, a legitimate tradable bottom at least, we need to see an explosion in the VIX here. We need to see excessive ratings such as back during the SVB collapse or in December last year. And for now, we're not there yet. Despite the label of extreme fear, the actual rating says we're not in extreme fear yet. We need to see puts at the 60s, 70% of the volume. Then we can say, okay, maybe we have a tradable bottom here. We move on to the unusual activities that took place on the options market on Friday. And we have the ticker AAPL Apple, the big kahuna. Interesting, they're picking on the biggest name here, with expectations of more declines to come. Somebody bought the 160 puts for the expiration date, December 1st, with expectations that Apple will go down and lose more than 7.5% of its value by then. Paid about $2.20 a piece. Enter this trade, all in all, spending about $3.6 million. And now we have the SPY, the S&P 500. They see it going down. Somebody's hedging big here. And they bought the 345 puts for the expiration date, November 24th. Expectations, SPY could go down by more than 18%. A Black Monday kind of scenario. And they paid about 55 cents a piece to enter this trade, all in all spending about $500,000. Then we have the ticker FIS for Fidelity National. It's part of financials, not doing so hot so this year, down about 25% year to date. Somebody sees a rebound though, and they bought the 55 calls for the expiration date December 15th, with expectations that FIS will rebound and gain more than 9% by the expiration date. Paid about $1.25 a piece to enter this trade, all in all spending about $1.2 million. What about the ticker ROST for Ross Stores? You would think that in a contracting economy and higher interest rates, higher credit card debt, maybe these kind of businesses will do pretty good. The answer is not really. The store is actually suffering higher wages, higher costs, the margins are not really doing pretty good here, and the consumer continues to shun away. So here we have somebody who's betting for more pain to come. They bought the 100 puts for the expiration date December 15th with expectations that ROST will go down and lose more than 13.5% of its value by then. Paid about $1.10 a piece to enter this trade, all in all spending about $1 million. And then we have the ticker IBB. This is the biotech ETF. Now with the Ozempic mania, we see a lot of these names getting hit really hard. With higher interest rates, a lot of these companies are overpriced, overvalued. And as interest rates go higher, you don't really need to take a lot of risk in the stock market here. So you get rid of highly valued companies. Most of these companies happen to be in biotech. So here we have somebody who sees more pain to come. They bought the 105 puts for the expiration date, January 19th, with expectations that the IBB will go down and lose more than 10% of its value by then. They paid about $1.40 a piece to enter this trade, all in all spending about $800,000. Last but not least, what about the ticker W for Wayfair? When somebody sees a massive drop here, they bought the 35 puts for the expiration date, November 17th. Expectations, the name will go down and lose more than 20% of its value by then. Paid about $1.40 a piece to enter this trade, all in all spending about $800,000. We move on to the heat map for the day. What do we see here? A sea of red, bloodbath across the board. Few exceptions based on earnings, few exceptions based on perhaps value hunting. So in healthcare, we see Abbott Laboratories, ABT, continuing to move higher on the heels of earnings, but we see some bargain hunting here in MRK. But we see money coming out of the Ozempic mania in Eli Lilly and NVO. We also see Philip Morris doing pretty good on Friday, but besides that, it was an ugly tape across the board. Financials, tech, energy, industrials, everything is down. We contrast this with the weekly picture here. What do we see? We see some winners, and you gotta take some note here. The big caps, that's where the money's coming out of right now. Apple down more than 3.25% for the week. Nvidia is down almost 9%. Tesla down a little over 5.5%. Amazon, Meta, Google, all down. The exception, of course, is Microsoft, holding pretty good for now, keyword for now. But we see names such as Oracle, an AI mania name. That's down about 6% for the week. The Ozempic mania, Eli Lilly, NVO, also down 4% and a 5.75% respectively. So we see a lot of problems here, signaling that we have risk off. We have a lot of investors, a lot of money managers saying, okay, this doesn't look good geopolitically, fiscal side, monetary side, bond yields. We're going to take some risk off the table here. And the question now becomes, are they rotating into something else? It's really hard to answer that looking at the map this week because we could see some reactions based on earnings for now. We talked about Abbott Laboratories. We have Netflix as a winner for the week, but hard to say that it was due to a rotation. We know that it's due to a mechanical reason because of the heavy shorting prior to the report coming out. And by the way, we played this one beautifully in my Discord. Netflix and Tesla, we nailed both. But we see AT&T Verizon doing pretty good because of AT&T's earnings. We see energy catching a bid. We see names such as in defensives, Procter & Gamble, Coca-Cola, also catching a bid because of earnings. But then we see other names that caught some flows. Maybe in some of these names, we see rotations. You look at Mondelez, for example. No earnings, but the stock is up. We see Nike. A lot of managers talk to me and they say that we see Nike as a value now. So we see money pouring back into Nike. McDonald's. We talked about McDonald's. We played it pretty good on Discord. Food stocks. All punished because of the Ozempic bullshit. Now a lot of managers say, okay, maybe McDonald's is pretty good. It's a solid company. It's a reliable company and it's down big. I'll take a chance and rotate some cash out of Apple, out of Nvidia, and buy McDonald's. But most of the money is staying in cash, chasing gold, chasing oil, chasing hedges for now, or at least just staying in the sidelines, waiting to see more clarity when it comes to earnings, but also the geopolitics. We contrast all of this with the weekly heat map for the ETFs, a sea of red across the board. You look at the TLT right off the gate, and we see that it's down about 5% for the week, so we know the bond yields went higher. Right off the gate, we see any yield-sensitive ETF down. IYR, real estate, down big for the week. ITB, construction, XHB, home builders, all down big for the week. XLU utilities, down big for the week. Staples, the XLP, yield sensitive but managed to close positive. And this supports my theory that in consumer non-discretionary, in the staples, we see value investors beginning to show up here as dividend investors exit these names. Of course, we have the XRT positive for the week because of retail sales, and then we have energy also up for the week because of the hedges when it comes to geopolitics. But technology down, KRE, regional banks also down. Yield sensitive sectors. What's working is also GLD, gold, SLV, silver. So for now, the formation is really defensive. Even in international markets, the offensive, of course, being China. And we see money coming out of the FXI, MCHI. For now, the theme remains risk off. And for those who told me last week that, oh, Maverick, the market doesn't care. The market is going to brush off bond yields, the dollar, the geopolitics, doesn't matter. Well, the market loud and clear is telling you it does matter. We're beginning to be concerned here. Keep that in mind. We move on to charts and then wrap it up. We begin with SPY, the S&P 500. This is an hourly chart. What do we see here? On Friday's session, we got a nice rebound. The flush down, of course, began once we lost 430. And we talked about these targets on Discord step by step. If we lose 430, you're going to buy the 426 puts. We lose 426, we're going down to 420. And 422 was an important support line on Friday because it was almost at the 200 days moving average. And the market maker kept finding it over and over and over again. But I told my followers, let's go guns blazing here, buying the 420 puts. And we managed to break the market maker here. We screwed Citadel for the first time, and we managed to make the market maker close below the 200 days moving average. Single-handedly in this channel, folks. I'm joking, of course. But we look at the daily chart for the S&P. What do we see here? We lost the 200. You look at that in blue, that's the 200 days moving average. We lost that at a much higher than average volume. Now we have a confirmation on the RSI with negative divergence. We have a confirmation in the MACD indicator of bearish momentum showing up. On top of that, we know that we have a pattern of lower highs, and now we have a pattern of lower lows. The question now becomes, since we lost the 200 days moving average, where do we go for the lower low? And my answer is we have a gap that goes all the way back to the month of May. Maybe that would be a good point for a lower low. Keep that in mind. Let's do the cash index, the SPX, just to give some of you targets for those who trade the SPX, not the SPY, on the weekly chart. What do we see here? We lost the 20 weekly moving average. That is bearish, not bullish. We're now forming a bear flag pattern that is playing out. We're at the lower Bollinger Bands. And now we have to look down for support at around the 50 weekly moving average, and that will be 4185.5. That will take us all the way down to the range for May. If we look at the monthly chart for the SPX, what do we see here? Using Fibonacci retracement lines, we know that we're getting really close. 4,200. Is a really important number. A closing below 4,200 from a monthly standpoint will confirm what? Number one, the negative momentum on the RSI and the MACD indicators. Number two, the fact that we have a lower high on the monthly chart, which means we're done here. We made a top, we made a mistake, and we're going to correct it in a violent way. And losing 4,200 on a monthly basis will open the floodgates. The next support we have is all the way down at 38.15. That will be a downside of about 10% from this point on. If we look at the E-mini futures daily chart, what do we see here? We lost the most important line for now, 4,300. Now, there is still hope that we can have a double bottom at this point at around 42.32. But with the volume that we see and the momentum that we see in the RSI and the MACD, in all likelihood here, it is really hard to say that 42.32 will hold the support. In all likelihood, we're going to break that, and then we begin the conversation of 41.50. 100, which again will take us back to the range from May. If we look at the Qs and hourly chart, what do we see here? We lost two critical supports. Number one, 367. That was shorting signal number one because the floodgates opened right away once the chart lost 367. And then we have 357. We closed below that on Friday. So now we know that the hour size is getting a little oversold here, but it opens the possibility that we could see an inverse head and shoulder pattern. And it could take us all the way down to the last support we got here, 351.36. If we look at the daily chart for the Qs, what do we see here? We lost the 20 decisively now. And we know that we have a pattern of lower highs and lower lows. We're losing momentum. RSI, MACD, confirmations, the sell-offs at much higher volume than average. All signals that we're going down. And the next support that we got is 352. That would be the 150 days moving average. When we look at the daily chart for the NASDAQ futures, what do we see here? We lost the most important line, 15,000. Much higher than average volume. The momentum indicators RSI and MACD are now showing bearish momentum. And the last line of defense is 14,675. If we lose that, we could risk a flush down scenario. When we look at the weekly chart for the NDX, what do we see here? Number one, we have negative momentum in the RSI. We have negative momentum in the MACD indicator. Number two, we lost the 20 days moving average. Number three, not only we lost the 20 days moving average, we lost it by losing 15,000 too. And now we're forming a bear flag pattern, showing rejection from both 15,000 and the 20 days moving average, and now the bear flag is playing out. And that is the 20 weekly moving average, not the daily. Now we have to look down at the 50 weekly moving average. That will be down at around 13,462. But before that, in my opinion, we could see support in or around 13,710.82. That would be the top of the bear market rally from 2022. And that is a critical point. Maybe at that time, it would coincide with the 50-week moving average. So we'll see. IWM daily chart, what do we see here? Number one, we lost the last line of defense, 169, after getting rejected repeatedly from the 20 days moving average. Now we have a flush down scenario on higher than average volume. The next support we got is 162.5. Now I am aware that on the Bollinger Bands, we're getting a little excessive here. We're getting outside of the lower Bollinger Bands, which merits a rebound. But can you bet on it? We have seen that charts could be below the Bollinger Bands, above the Bollinger Bands, in most cases by 3 to 4 candles. We only have one now. Who's to say that this is not going to be a catch a falling knife scenario? For now, I would either wait to 162.5 or wait for a solid reversal signal, because you look at the weekly chart here for the IWM. What do we see? Yes, we're outside of the lower Bollinger Bands, but we could expand that a little more, all the way to closing the gap at 162.5, and then maybe we see more of a reliable rebound. We look at the dollar daily chart. What do we see here? The obvious is the weakness that we see in failing to keep the 20 days moving average support. We have a lot of arguments that this could be an ABC pattern and the dollar is going down. At the same time, since the C leg is not playing out and we're running out of time here, one could argue that this could be a bull flag consolidation pattern. For now, absent of a resolution, we can't say one way or the other. But the dollar is a lot weaker than bond yields. We can say that for sure. When we zoom into an hourly chart, for the Dixie, what do we see here? We have what we call the shoulder zone and the leg zone. We've been talking about this throughout the week. Now, unless we have a break one way or the other below the leg zone or above the shoulder zone, we can't say that the dollar is bullish or bearish. For now, it is stuck within a range. So what do we do with the old man gold? Now, gold has been rallying despite the dollar. At this point, the dollar doesn't matter to gold, at least right now. And the reason is we have the geopolitical fear. So we see a lot of hedging, a lot of de-risking and buying gold. The question now becomes, has it become a little too excessive? The answer is yes. We got to the round number of 2,000. We saw a reaction. We saw profit taken right away. We're now at the top of the Bollinger Bands. You look at the RSI, it is overbought too. So can we see money coming out of gold here? The question now becomes, well, what about the Middle East, Maverick? Are they going to still book profits even though we have more and more escalation in the Middle East? Maybe give us a pullback. And then maybe a rebound and a buying opportunity. But for now, if you're not in gold, what is the risk versus reward if you hop in right here? That you could be the Johnny-come-lately and the holders are selling to you. And we see a drop down in gold. And the same can be said with SLV silver. We got resistance at around 21.43. We closed below. We closed below the 200 daily moving average. There is some signs of exhaustion here that sure, maybe we should bet on gold and silver, but did we overreact a little bit here? Or shall we say, in other words, maybe it's too good to be true to have that much profits in a short amount of time. Somebody sees a dollar sign here. Somebody sees, okay, I know that I need to buy gold at some point again, but boy, this move is sweet. I want to book it. I want to get my profits here. Go out for a little bit, watch the news, not stoned though. Otherwise, I'm going to tweet some crazy shit. And if the news is not getting any better, then I'm going to buy the dip in silver and gold. Something to think about. We look at the daily chart for UK oil. What do we see here? Above the 20 MA, a little bit of a pullback on Friday. Doesn't change anything here. It would have been better, of course, if the chart of UK oil broke the lower high pattern, because now we have the risk that we could see a pullback from this point here. And if we lose the 20 MA, that would be a confirmation that we have a lower high. And that would be bad news for oil bulls. XLE, daily chart, bigger pullback than the commodity itself on Friday. We warned a lot of the viewers on this channel, don't be too greedy now. Book some profits at 92.5. That was the right call, because now we see a drop down. It doesn't erase the bullish momentum here, but maybe it opens the path for a retest to the 20 days moving average in white, and then we see what happens. We look at the 2-year yield daily chart. What do we see here? We did not have a bull flag breakout, but we are within the support of 5.085. And we could be actually seeing an inverse head and shoulder pattern. We haven't seen something meaningful here, such as a lower high or a lower low, to say that the 2-year topped and maybe trending down from this point here. But of course, all eyes on the 10-year. If we look at the daily chart, we've stopped short of trading above 5% clean. A lot of folks would say that this is a sign for a top, and we're at the top of the Bollinger Bands. Maybe bond yields go down this upcoming week. We see a rebound in equities. Maybe. But look, we did not get all the way here to 5% just to give up at this point. Whatever pullback we're getting in yields, the assumption is they're going to rebound. We're going to make it above 5%. Once we make it above 5%, the algos will be triggered to sell. The algos already triggered to sell the moment the S&P closed below the 200 days moving average. Add a double whammy to the algos. By the 10-year breaking above 5%, we could see a big flush down in equities. Be careful at this point trusting any rebound. When we look at yield-sensitive ETFs such as the XHB, on the daily chart, it is becoming a little oversold here outside of the lower Bollinger Bands, but no sign that we have a bottom or rebound coming. But at some point, we're going to get oversold. At some point, we're going to get a rebound based on mechanical and technical reasons alone. Here's the problem. On the longer time frame, if we look at the weekly chart, for example, the selling is now at much higher volume than average. We have negative momentum in the RSI, negative momentum in the MACD, and even the Vortex indicator is now giving us a confirmation that the XHP is bearish, not bullish. So whatever rebounds we get in the daily chart, based on pullbacks and bond yields, will be short-lived. And I see support all the way down at 68 here. Another rate-sensitive ETF is the XLP, Staples. Now we can see that it is failing to crack above the 20 daily moving average. But who's to say that we're not seeing a consolidation here in a bull flag pattern? If we have a breakout and the XLP closes above the 20 days moving average, then it is safe to do some bottom fishing here in these consumer staples, be it General Mills, Conagra, Coca-Cola, even McDonald's can be included in these names. When we look at the VIX daily chart, what do we see here? Above 21.33, a breakout point. Momentum is all bullish. Nothing to see here besides maybe a little too excessive. Maybe we're above the top of the Bollinger Bands, and we see a pullback, a retest to 20, for example. But does it change or erase the bullish outlook for VIX? The answer is no. If we clean it up, we have a confirmation for a cup and handle pattern on the daily chart. On the weekly chart, we are now amidst a breakout. You can see the momentum in the RSI and the MACD. It's not overbought yet. It could be if we go all the way to target number 1 at 25.84 or all the way up to 29. The bottom line is we are not finished with the downside in the equities market here. The VIX has one more major move to make here before we can say, okay, we got a bottom at least for the year, and we can have the end of the year rebound, Santa rally, whatever we're going to call it. But it's not going to come right now. One more dump, and maybe we're done for the year. The problem, of course, now becomes, what if it is a major dump? What if it is a Black Monday kind of dump? That's the risk. And that's what we watch for. Apple, Big Kahuna, hourly chart. What do we see here? Once it broke 175.38, the trade was to buy the 173 puts. That played out. On Friday, we said we have to go down by the 170s now. Why do we say that? 173.54 is broken as support. There's plenty of momentum in the RSI to go to the downside. On top of that, perhaps more important than the hourly chart is the daily chart. If we look at the momentum indicators, be it the RSI, the MACD, the Vortex indicators, all pointing out for bearish momentum. On top of that, we lost the 20 MA, Now we have to look down at the 200 MA, and that would be in or around 169.5. Apple doesn't look pretty good here. How about the souffle, Tesla? Daily chart, what do we see here? Looks awful. It lost the 20. Once it lost the 20 moving average, I said, look, the bias is to the downside when the report comes out. We played it, paid off. Now we have Tesla below the lower Bollinger Bands and below the 200 days moving average. It is an extremely bearish breakdown. With that being said, can we see a relief rebound? Can we see an oversold rebound? I would say we're getting really close to that outcome. And maybe we see once Tesla recaptures the 200 days moving average or trades above the Bollinger Bands again. It could be a massive trap. You gotta be really careful here, and the reason is, if we switch to a weekly chart, what do we see here? We see a bearish, flaggish pattern. It played out by the loss of the 20 MA on the weekly chart. Now we have to look down for the 50 MA at around 205.98. We can round that up to 206. But the bottom line is, RSI and the MACD indicators both showing negative momentum. On top of that, on the monthly chart, the scariest of them all, we see the classic head and shoulder topping pattern. We see the momentum on the monthly chart now becoming bearish again. Be careful, this stock will trade below 100. I would say even at 60 when this movie is all said and done. NVIDIA daily chart, what do we see here? Lost the 20 MA, lost 424.80, a critical support line. Confirmation of the topping head and shoulder pattern, selling at higher volume than average. Now we have 405 as support number 1, then we have the 100 moving average at 387.83. But most importantly, if we look at the weekly chart, what do we see here? Topping head and shoulder now confirmed by the loss of the 20-week moving average. RSI is now showing negative momentum, along with the MACD and the Vortex indicators, all giving us confirmations that NVIDIA is now bearish, not bullish. And what happens if this stock breaks? That would be a major event for the stock market this year, the rise and the fall of NVIDIA. If we use the monthly chart and we use the Fibonacci retracement lines, we know that 409.5, it's actually 55, but we're going to round that down just to be safe. If that's broken, if we have a monthly closing below this number, then the top is in, and we have to look down for the next support at around 352. Lastly, Bitcoin tulips. What do we see here on the daily chart? We see when we use the Bollinger Bands that we're getting a little too excessive here outside of the Bollinger Bands, and the RSI shows overbought signals. It would not be out of the ordinary to see a pullback, but the pullback should not get us below 29,200. We should keep that as support, otherwise it could be a fake pump and Bitcoin goes down from this point here. To be safe, we need to see it closing above 31,000 just to get out of this range once and for all. Otherwise, buying right now could be a trap. You buy, then we see it drop down, we lose 29,200, next thing you know, 26,555, and then what? So Bitcoin has to do a lot of work on our behalf before we hop in and say, okay, it is safe. We have the green signal to buy Bitcoin right now. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, we have nothing. Could be a good rebound day and nothing heavy really on the earnings calendar. But Tuesday, the 24th, we have the chiller home price index. We have the services and manufacturing PMIs. Wednesday, the 25th, we have new home sales. And then Thursday, the 26th, heavy slew of data led by GDP, initial jobless claims on top of durable goods, the trade balance, retail inventories, wholesales inventories, along with pending home sales. Friday, the 27th, we have personal income, personal spending, but most importantly, the PCE inflation rate, which is the Fed's favorite. And then we have the final reading from the University of Michigan regarding consumer sentiment. With that, folks, a reminder, if you're not a member of the channel yet, consider joining. We've been doing pretty good. A lot of folks making a lot of money. So do us, and most importantly, yourself a favor by joining. Other than that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow. Good night.